See everybody, and thank you for joining the call. As you can hear, I'm a bit sick, but as founders yourselves, you know that it doesn't matter whether you're sick or not. You still need to show up to work. So that's a good example for that attitude. Yes, thank you for all the thank you. But yes, good to see everybody, and I want to start by introducing myself. My name is Tal. I'm the founder of Gelt. I'm based in Tampa, Florida, by the way, so which is a great place for taxes. I recommend it. Um, but based in Tampa, Florida. I'm a tech guy transitioning to taxes. I built companies before. I sold some of my companies, and I got screwed pretty hard when it comes to my taxes overall. And that's kind of like what led me to the world of taxation and becoming kind of like what I would define as passionate. And my wife would say obsessed, so it's really depending on who you're asking, but that's kind of like how I got into taxes and how Gelt came to be a company. Gelt is basically a tech-enabled service. One side of the company, we have CPAs and tax professionals in-house. The other side of the company, we have engineers, product managers, designers, building our tax technologies, and we provide the tax services to high net worth individuals and businesses in the US. So we are hyper focused just on taxes, and even within taxes on sub specialty of taxes, and we are working only with US taxes specifically. But that's kind of like the background about us. We're about 70 people right now as a company. So the company grew up quite significantly in the past couple of years. We're VC backed. We raised over $20 million, and we are doubling and tripling every year. So I would say that it's going pretty well. But honestly, the privilege is really to help people save money on taxes. I think that it's really a calling from that perspective. I truly believe that people should pay the least amount of taxes legally possible, with emphasis on the legally. And saying all of that, let's get started. Um, I want to start by just explaining as a background what are the different types of services when it comes to accounting, tax, and finance, because I know that there is a lot of kind of confusion. And I took like four types of services that usually businesses use or need depending on their stage. I'll start with the first one, which is bookkeeping. Bookkeeping is basically taking all the financial records of the business and organize them in a way that will allow you to produce financial statements. Financial statements are basically profit and loss statements, summarizing your income and expenses, or balance sheet, which is like assets, liabilities, and equity. Um, and that's the baseline for everything. It's something that we highly recommend everybody to have from day one. Some people think that, oh, I can just open a spreadsheet and organize everything there. In our experience, it's almost always doesn't work. Um, I'll give an example for me and my entities and my businesses. Even so, I know quite a lot about taxes and I probably can do my bookkeeping myself. I still outsource it to a bookkeeper because it gets complicated and the cost of mistake is so high that it doesn't worth it. So it's an upfront cost that we highly recommend people to invest. Financial statements is the baseline of a lot of the decisions that you will make as a business owner. That's the number one, and that's the role of a bookkeeper. You should expect from your bookkeeper to reconcile your financials, and produce clean financial statements for you. If you see a huge line that says like uncategorized expenses, that's bad, and you should push back on the bookkeeper, by the way. The second thing is sales tax. Sales tax is basically, depending on the state or locality, it's something that you might need to report and pay and to that jurisdiction. It's really depending, each state has their own rules, each locality has its own rules. So it's really depending on what you have. But usually when you start selling and cross the $20,000 in sales, you should start at least have some kind of conversation with a provider about sales tax to make sure that you don't get screwed by that later on. They're quite aggressive about that, and you see a lot of audits when it comes to sales tax. It can also come up in due diligence if you ever sell the company. It's one of the areas that people look at the most, by the way. So it's something that you want to keep in mind, but it's a kind of its own niche when it comes to sales tax. And it's And it's usually sales tax is basically taxes that are subject on each sale you're creating. So if you're selling like, I don't know, like one of your products for $10 in California, in the Bay Area, it might be different sales tax than in Tampa, Florida, because its jurisdiction has its own kind of rules. So it's taxes that the states and localities are adding on top of your sales, and you need to report it to them. Usually you would offset that cost to the clients, by the way, and to your customers. States are aggressive about that, because for a lot of states and localities, that's the main source of revenue for them. So that's why it's kind of like a big deal for them, and why they are putting a lot of effort to make sure that people are paying it. Then you have income taxes. And that's, by the way, what Gelt is doing. Income taxes are basically taxes that the federal, state, and local authorities charge you based on your profits. When I say profits, it means tax profits. The profits as reported in your tax return. If you have no profits, you need to pay no taxes, usually. But if you do have profits, a lot of the time taxes are becoming an issue. And that's basically what we specialize in. We help basically successful businesses to lower their tax liability on their profits. And finally, it's CFO services, CFO controller services. Those services are usually provided by like senior accounting professionals, and it's kind of like high-level management and overseeing of the whole finance operation. It can be from managing the bookkeeper, sales tax, and income tax providers to creating forecasting and financial analysis, and give you more insight about your current and future situations. But that's what CFO services are doing. And those are kind of like, I think, summarizes like the services that you should know about and care about. Usually people, by the way, need CFO services when either they are completely lost in their finances, or they just spend too much time on finances and not growing their business. That's usually when you start to look to outsource everything. Okay, now we can continue. I want to get started by talking about entity selection, and start by explaining the differences between entities. I'm sure that you heard about those terms that you're seeing on the screen right now in your life and when you started a new business. LLCs, corporations, S corps, C corps, etc. So the way that you want to think about it is that the world in that area split into two. You have the legal entity and you have the tax treatment. The legal entity is basically how the state, you're registering a company with a specific state, usually, is how the state treats a specific company. LLC, a limited liability company, or a corporation is a legal entity type. It defines kind of like the legal side of starting a company. It has nothing to do with taxes right now. It's purely legal liability protection, like what kind of like filing you need to do with the states that you open the company in, but that's all the business in. That's basically the legal entity side. Then you have the tax treatment. Each legal entity has the tax treatment. Tax treatment is basically how the IRS and state authorities are seeing those businesses. For example, if you start an LLC and it's just you, one owner of the LLC, it's called a single member LLC. Owners of an LLC are members. Single members LLCs are basically taxed as disregarded entities by default. If you don't make any elections or anything else, you will get taxed as disregarded entity. Basically report all of that operation on your Schedule C, on your personal tax return. You don't need a different tax return for that. It's all being reported on your personal tax return in a special form called Schedule C. And there are pros and cons for that as well. LLC is, by the way, the most flexible type of entity. You can have an LLC and be a disregarded entity, elect the LLC to be taxed as a partnership. Or by default, if you have multiple owners, you can make an election to be an S corp, so an LLC taxed as an S corp, and you can even make an election and make an LLC taxed as a C corporation. So LLC overall is the most flexible type of entity. Then you have a corporation. A corporation by default is being taxed as a C corporation. A C corporation is its own legal of course, all of those are their own legal entities, but it's kind of like a split into two. Everything that happens, it's called also a blocker entity. Everything that happens within the C corporation stays within it, meaning that all the all the profits, all the losses are being taxed on the C corporation level. So if you made $100 and you have $100 in profits, let's say, you will pay taxes on the C corporation level and not on your individual or the owner level first. The C corporation tax right now is about 21%. Depending on the state, it might be more. You might have also additional state taxes. But and usually people are electing to be corporation taxed as a C corp when they have investors, when they are optimizing for QSBS, which we'll touch later on. But usually that's the reason why you would do that. A corporation can also be elected to be taxed as an S corporation. An S corporation is actually a pass-through entity, which basically means that you pay taxes on the S corp level, on the individual or the owner level. So all the profits, the $100 of profits that you generated, basically are flowing through to the owners, and then each owner will treat it based on their situation. This is especially like one of the more favorable like forms of tax treatments, especially for bootstrapped founders overall, especially if you cross the $120,000 a year in profits. Profits, not revenue. So profit is what's left after all the expenses, basically. But those are kind of like the types of entities that is important to know. There is also a partnership, but partnerships are very flexible type of business, but we can talk about it maybe in a different session. Maybe one more thing about S corporations. People elect to be an S corp owners, or like to make the S corp election when they want to optimize specifically for Social Security and Medicare payments. So in order to reduce the Social Security and Medicare, S corporation basically is giving you a way to do that, and that's why people like it. It can be depending on your profits, anywhere between $7,000 of savings to up. We have clients that save over $30,000-$40,000 depending on your profits that you're going to generate and what you're going to do. But that's kind of like why people usually elect to be S corp. So just to sum it up, S corp is usually people who are bootstrapped, like very profitable, bootstrapped, no investor. That's usually when people choose S corp. C corp is usually the default way when people have investors. The investors themselves will usually require them to be a C corporation, and usually they would want the company to be set up in Delaware as well, which is kind of like the standard right now for legal reasons, not tax reasons. Okay, now we can move on. I think that when we created the presentation, I asked like what were the people going to join and be here, and we kind of like split the people to 3 buckets right now: bootstrap but not profitable yet, bootstrapped and profitable, and investor backed companies and businesses. Because the majority of the people here are bootstrapped and profitable, that will be the focus of this call overall. However, we are going to make a couple of mentions about the bootstrapped and not profitable, what happens to the losses, and also to investor-backed companies and what's the thing that they should care about from a tax perspective. Move on. So I want to start by explaining that your P&L decides really your tax bill. Basically, it's the profits. And the fact that you add cash out of the business does not mean that it's deductible. Not everything that you spend as a business owner is actually going on the P&L. For example, if you're buying a nice couch for the business area of your home, obviously, and the couch costs $4,000, and because it's a business-related expense, you want to put it on the business. It does not mean that you get to deduct $4,000 because the couch is being used over time. the couch will be depreciated and not fully deducted, because the IRS would treat it as an asset and not as like an expense, something that you use once and that's it. So there is a difference between an asset and an expense. Assets, sometimes, depending on what asset it is, you cannot expense right away unless you have special provisions that help you to accelerate the depreciation or expense it right away. An expense is something that usually you can take the same year as a deductible from your revenue. Then you have a certain exception because you are a lot of you are dealing with inventory. There are special exceptions to those rules, because usually inventory, you're not able to treat inventory as an expense. So if you bought like $100,000 by default, if you bought $100,000 of inventory in a certain year and you sold $90,000 of that, you can basically treat only $90,000 as a deductible expense for that year. There are certain exceptions for businesses that on average generate less than $32 million over the past 3 tax years, which is, I guess, the majority of you guys, unless if it's not good for you. But usually in those situations, there is an exception, and that might allow you to fully deduct the whole amount the same year, but it's very nuanced, and you should work with your bookkeeper and tax professional in order to determine whether it makes sense for you or not. And lastly, it's draws versus payroll. You need to pay yourself, you make money, you need to pay yourself. There is a difference between the W-2 that you can take from the business and the draws, which is relevant for S corporations and C corporations, and the draws, basically the dividends or the owner's draw that you're making from the business. The payroll portion is deductible on the P&L, but any draws that you have like for the business, that's something that goes to your equity actually and affect your basis, or it's basically treated as a dividend. So that's another thing that you want to understand, that there is a difference between money that you pull out of the business when you give yourself payroll and money that you pull out of the business in other way, like draws, dividends, or anything else. And all of that is based assuming that you know your profit. And this is another way to emphasize, you need to have financial statements. Financial statements are really important. You want to make decisions based on data that you're seeing in front of you. Yeah, we can move on. If you're a profitable business, I'm sure that a lot of you guys are operating your business from your home, or you're using personal property or personal expenses for the benefit of the business. I want to start by home office deduction. Home office deduction is basically talking about the area of your house that is exclusively dedicated for business usage. For example, portion of my house that my wife really hates me that I'm doing that. We have a lot of merch of the company. And all of that area that is purely dedicated for the business because it cannot be used for any other purpose can be deductible on my taxes when I claim my home office deduction. Generally speaking, you have multiple ways to calculate home office deduction, but the concept is similar. You are taking the area of your house that is dedicated for the business and calculate what's the value of that area, depending on if you have a mortgage, it's related to your interest payments. If you're renting, it has to do with your rental expenses. You're taking that portion, and that portion might be deductible. This is only for profitable businesses. For example, non-profitable businesses, if you're losing money as a sole proprietorship, basically as an LLC, single member, not an S corp, a lot of the time you will not be able to take the home office deductions. So if you're losing money right now, it's really important to consult your tax professional before you're making the decision how much you can take from your home office. And beside that, you have vehicle. A lot of you guys, I'm sure, using your vehicle in order to do either delivery or like use it for business purposes, to go for business meetings, to do deliveries sometimes yourself, going to the post office to send things. Portion of that vehicle that is being dedicated or used for business can also be deductible. We have a client actually that they are basically a logistic company, and they employ quite a lot of people, and they have kind of like a fleet of vehicles. If a vehicle basically weighs more than $6,000, we also have special provision that allow you to fully deduct the value of the vehicle from the business instead of depreciating it, because the vehicle is an asset. But if it's not like 6,000 pounds, you will be able to deduct portion of the cost of the vehicle from the business, depending on the mileage and the actual use of the vehicle for business purposes. So that's another number that you want to work with your tax professional in order to figure that out. And lastly, it's the phone and internet, and which is one of the areas that there is very little guidance from the IRS how to calculate it, because you're using your internet right now from your home to talk to your tax professionals or to do business. How much of your internet is being used for business percentage compared to personal? How do you exactly measure that? It's unclear. So that's something, another thing, like work with your tax professional to figure out what number is most relevant to you. And you will be able to deduct both like portion of your phone as well as portion of your internet expenses from the business. I have maybe one thing to mention. Sometimes taking advantage of those expenses might be problematic if you have partners, because imagine that you have two partners in the business. Each one of them want to take their home office, and each one of them want to take their own portion of everything, and it might not be equal. And of course, it affects each other at the end of the day. In those type of situation, when it's not just a solo business owner and you have a partner, there are certain entity structures that can solve those issues and create a separation. But that's something, again, that it's a whole topic by itself, and we can maybe do a session on that alone, how to maintain good relationship with your partner, which is the most important, by the way more than taxes. How to maintain good relationship with your partners when you build a company, when it comes to expenses, of course. All of those expenses, when you are an S corporation, and a lot of the profitable businesses will be S corporations, must be documented in a written policy called an accountable plan. That's not something that I made up. It's the IRS came up with that. They demand each S corporation that wants to take advantage of mixed expenses like the ones that you're paying right now, basically to have a written policy that dictates how much and what percentage and what's the split. And that's another thing that I like to work with your tax professional in order to take advantage of. There are other areas around those. So like some people want to hire their children or family members to help with the business. Some people maybe heard about the Augusta rule that you can take advantage of. So there are other ways to really use other deductions and expenses in order to optimize your tax situation, but we have only 1 hour and it's not enough to cover everything. So cover this, then we can move on. The next subject that I want to talk about is really retirement planning, because if you have a nice portion of profits, you're going probably to take some of the money, use it for your day-to-day life, but some of it, I hope at least, will be used to save for the future and be responsible for your current family or your future family. I like to tell clients that I never heard a spouse complaining to I never heard like a wife complaining, and it can go both ways. A wife complaining to a husband that I cannot believe you contributed too much to the retirement. I cannot believe you worried about the family and the future too much. So you don't have to maximize how much you're contributing to your retirement, but definitely it's something that with your own financial planning, we recommend that you would consider. Generally speaking, if the business has only no employees, just the founders, there is a retirement plan called Solo 401k that basically allows you to contribute $72,000 from the business and the individual to the retirement account. You don't have to contribute everything. Those are just the ceilings. Those are just the limitations. You have similar limitations you have with SEP IRA, which is a bit simpler. If you have a choice between Solo 401k and SEP IRA, choose the Solo 401k. In 99% of the times, it will be more advantageous for you, but it really depends on your situation. We very rarely saw situations that SEP IRA actually made more sense, but it happened. So generally speaking, Solo 401k, SEP IRA, two retirement plans, different rules. We don't have to dig too deep into those right now, but as a rule of thumb, Solo 401k tends to be more advantageous. If you do have employees, or alternatively, you have really a lot of profits, like you're making over $400,000, $500,000 a year, and you really hate paying taxes and want to save as much as possible. So if you have employees, you have 401ks, not Solo 401ks. So Solo 401k and 401k, two different plans, two different rules. But 401ks is usually something that you can build for when you have employees, and then you need to provide them with 401k benefits as well. On top of yourself. And if you really have a lot of profits, there are some things that are called cash balance plans or defined benefits plans that allow you sometimes to defer 6 figures to the future into retirement in certain situations. But that's kind of like as overall. And last item, most of the time you're making those plans and those retirement planning overall during the year. If you finish the year, let's say we are right now August 25th, 2026. We finished 2026 and we did not open the SEP IRA or the Solo 401k and we have nothing established. In many cases, it's already gone and you will not be able to do it after the fact. And you just lost some money. Sometimes contributions can happen before the deadline, sometimes not always, but it's something that you want to plan and do throughout the year and not after the year ends, because a lot of the time it's too late. So that's actually a core principle in tax planning. You plan ahead of time. You don't plan after the fact. A lot of the time after the fact, it's just too late. And nobody can save you at that point. Like nobody can change the rules for you or do something that is fishy and stuff like that, because, we're all working in the wonderful system that America is giving us. And it's a fair system, but you need to follow the rules. That's all. And to plan that ahead of time and not after the fact. I want to touch for bootstrap founders who, especially in the first year or two, when you just start a business, a lot of the time you're not making money, you're losing money. And a lot of people that when they're just getting started with something ask us, what happens if I lose money? Do I even need to report it on my taxes, or what happens to those losses? So the number one thing, yes, you do need to report it on your taxes, even if it's losing money. If it's consistently losing money and will never make money, the IRS might say that it's not even a business and it's a hobby, but that's a different discussion. But assuming that it is going to be a business and you are going to make money at the end of the day, the losses that you generate early on, especially if you are an LLC, disregarded entity, or any pass-through, flow-through entity that the losses are going up to your individual return, you will be able to take those losses against your other sources of income. Meaning that if your spouse is making $10,000 and you lost $5,000 operating the business for the first year, you will be able to take those $5,000 and deduct it from your spouse's $10,000. That's totally possible. Now, you have limitations because the IRS likes to have limitations in order to avoid abuse. And like the limitation for singles is $256,000 in 1 year. For married filing jointly, it's $512,000 for 1 year. For this year at least, it might change every year. If you have too much losses, meaning that you have like $1 million of losses. You can take up to, what it means, you can take up to 512, well, assuming you're married filing jointly, you can take up to $512,000, deduct it from your other income that you generated or your spouse generated, and then the remainder will be carried forward for future years. And this is something important to keep in mind. Carried forward for future years requires you to make sure that something is being carried forward, meaning if you do not carry it forward or you don't report it properly and you don't take into account prior year carry forwards and you miss something up there, you might lose that deduction or require to file an amendment, which is just expensive. We have seen too many cases, unfortunately, of people coming to us from other providers, tell us, hey, it doesn't make sense. I lost money for the first 2 years and suddenly I need to pay like so much in taxes. And we tell them, listen, we do not see anywhere that it says that you lost money more than you take. And we find out that there are mistakes. Sometimes those mistakes can be fixed. Sometimes it cannot be fixed. If too much time passed since the losses occurred, like the IRS might not accept any amendment. So there are a lot of kind of nuances around that, and you want to keep that in mind. Yeah, we can move on. If you are very profitable or VC-backed company, there is something that probably you heard about called QSBS. QSBS is Qualified Small Business Stock, Section 1202, if you want to read about that a bit more. And basically, it's one of the biggest tax benefits for entrepreneurs in America, in my opinion. We're seeing a lot of business owners taking advantage of that and doing really cool things there. But basically, what it says, and I'm sharing with you the new laws because it changed last year in 2025. But basically, if you are a C corporation, basically an entity taxed as a C corporation, and you hold the stocks in that entity enough time, and you need to hold the stocks enough, not the options. You hold the stocks of the entity enough time, you're eligible for up to $15 million of exclusion from your federal taxes. That's a lot of money. So if you are selling the company for, let's say that you are one owner selling the company after 6 years of working your ass off, you're selling the company for $10 million. There is and you're a C corporation, there is a good chance that you will pay 0 federal taxes on that. Certain states accept that, certain states do not accept that. California, for example, California loves to be very aggressive with their taxes. They need to fund all the public projects, of course, and all the trains. But California, for example, do not comply with QSBS, and it's something that they will tax you on that amount. But on the federal level, which is most of the taxes, you will not need to pay any taxes. The way that it works, technically, there are certain qualifications, but assuming you are qualified, after 3 years, you will be eligible, after 3 years of owning the stock, you'll be eligible for 50% QSBS, after 4 years, 75%, and after 5 years and on, 100%. So that's something that you want to keep in mind. Another thing, and it's a mistake that we're seeing, if you have restricted stocks, a lot of the time you would want, in order to get that to work, you would want, I'm not sure if, by the way, if that's like correct, sorry for not reviewing it ahead of time. But generally speaking, you would need to file 83B election in order to lock in the current value of your stocks for future sale. You have 30 days from the grant in order to file the 83B election. The 83B election is actually letters that you need to send physically to the IRS and to the company, and you need like actually certified mail and documentation that it actually happened. And so you want to be very organized with that. It's usually relevant right when you start the company. Right when you start the company and you issue yourself stocks, a lot of the time the stocks will be restricted stocks, and it's relevant only for restricted stocks. And you'll need to file 83B election right away. It will cost you nothing. and basically you lock down like the current valuation, which is really important. If you have options and not stocks or restricted stocks, that's a different story, and there is a couple more steps to do in that case, but you can work on that with your tax professionals or attorneys in order to figure that out. QSBS, definitely something that you want to take into account, especially if you're VC-backed or investor-backed company expecting to generate quite a lot of income. And I think that's it. I'll take any questions right now.
I have a question, if it's possible.
Hopefully. By the way, I don't promise to know all the answers, but I promise to try or follow up.
I'm from Canada, so I'm a little confused. Like, how would that work for a Canadian, since I'm operating and doing business in Canada? Like, I know my product's going to go into America sometime, but just I don't think it's going to happen in the next year or two.
So is the company like formed in Canada? Like
Yes.
the base of the company is Canadian company?
Yeah, we're based. Our company is starting in Canada, based in Canada. We're a B2G company, so we're only selling to government sectors. So again, it will be going into America. I don't see it in the next 1 or 2 years. I think we'll be a little bit further down the line before we get there.
So definitely when it happens, you need to have like tax advice. But generally speaking, all of that not that relevant to you. But when it happens and you do go to America, and if you relocate to America, you'll need to set up new companies in America. And then some of what I just mentioned, especially the C corporation probably side, will be relevant to you depending on your structure. But generally speaking, that's those benefits and everything I shared with you so far are relevant in America. I don't know and think that Canada has the same level of benefits.
Have higher taxes apparently here in Canada with businesses. So here's another thing too, is like, so it only happens if I move to America with my company. So that, like, if I sell in America, like say my product goes into America and starts selling there, but my company stays in Canada, then I still don't have to worry about those.
It really depends. That's a big question. But the long story short, it depending how you're going to structure your operation in the US. Are you going to have a sister company? Are you going to have a subsidiary? It's a more complicated issue.
Okay.
If you intend to stay in America once you move, for sure, by the way, taxes in America are much more advantageous than taxes in Canada. From all of our Canadian clients that are living in the US, we know that because they consistently complain about taxes in Canada.
Yep. Yes.
And by the way, Canadians, from our experience, Canadians are the most appreciative of the US taxes when they come to America. One of the first things. But if you decide to move to the US, then depending on how you want to structure it, there might be some solutions, but definitely you'll have an exposure to Canada and cross-border issues.
Okay. Thank you.
Thanks. Yes. Next.
Hi, Tal. This is Gunjan here. I have 3 questions. One is, can a C corp entity be converted into S corp?
So if we go back to the slides about the entities for a second, depending how you structured it. If you have a corporation taxed as a C corporation and you want to convert to an S corporation, it might be possible. If you're an LLC, it is possible. Just the question is, what will be the consequences? Sometimes you have consequences of conversion. If you are already a C corp and want to change to something else, it might be a little bit more nuanced. But generally, it is possible depending on how you set up the company. And it's something
currently, so a situation like this where a entity is like newly formed and does not have any revenue generated, do we still pay taxes on it, or how are the taxes filed in that case?
If you're a corporation, by default, you will be treated as a C corporation if you didn't make any other election, and you will need to file taxes as a C corporation. If it's the first year and you just got started and you didn't file your taxes yet and everything is still open, you might utilize something that is called late S corp election and retroactively elect the company to be an S corporation from the beginning of the operation. But that's relevant in very specific cases.
Okay. The next question is that when you mentioned that home address can be used as a legal address, in that case, can that home address still be rented out, or will that be treated as a business entity?
The legal address is something else. Like, for example, you don't have to have the legal address, your home, in order to claim home office deduction. The truth is, at the end of the day, what the IRS cares about is what happens in reality. If you in reality genuinely use your home for business purposes, you may be able to claim the home office deduction, if regardless of the legal address of the entity. The question is what happened in practice, rather than which address is on the documents when you started the company.
Yeah, so that the profit and losses on that home address can still be treated as a corporate expenses, right?
Depending on the situation. Like, I need to look specifically what you mean. Like, the qualification to be in home office needs to be, for example, if you have the home office needs to be the primary place of business. So if you have like another office that you're there most of the time, home office might not be legitimate for you. So it really depends on the specific situation, but potentially yes.
Yeah, so considering only one home address is currently available and no office address.
Yes, but again, take it with a CPA.
Okay. And then the third question would be, like we do businesses with organization in different states. Like you mentioned, in California, we do not, there are a few things where we cannot apply for the expense related benefits. So in this case, when we are like doing businesses in other states, how is the taxes filed? Like, will that be specific to the address of where the C Corp is registered, or will that be like both?
So if I understand the question correctly, and fix me if I'm wrong, you are asking like, how do you know when you need to file with a state and what you need to file with a state? Okay. So there is something called nexus. Each state has different rules. So what's relevant in California might not be relevant in Florida or in North Carolina, for example. But generally speaking, when you're thinking about nexus, you want to think feet on the ground. Basically, do you have people, employees, people in the area? That's number one. Number two, what's the volume of sales that you have in the state? And number three, whether you have an office, a physical office, which is kind of feet on the ground as well, employees or an office in that state. Those are usually the things that determine whether you need to file taxes in that state or not, how much you need to do it. Like, and then you have two types of taxes. You have sales tax that you need to take into account, and you have like actually income tax that you need to take into account. So once you figure out whether, based on an exit study, whether you need or do not need to file taxes with that state, you'll be able to know whether you're obligated and what you need to do.
So the situation here is like, if we are doing business with Canada, suppose, do I have to file taxes in Canada or just in US?
I do not know Canada laws, so sorry. So that's something to ask a Canada income tax specialist. A lot of the times, like if you ask like a state, hey, do I need to pay you taxes? In many cases, they will say yes, because who will say no to free money, But if you ask cross border, so the threshold is very low when you do that. The question is how much is it going to cost you and what's the exposure? But you want to work with a professional to take a position. What does it mean?
Okay.
Like figure out whether, like, if you need to pay $50 in taxes in Canada, and it's going to cost you $5,000 a year to do all of that. Maybe you want to, of course, it's not a recommendation to break the law or of anything, but you need to make that position for yourself. So work with a professional, understand where you stand, and take a position based on the recommendation.
Yeah, because many times the business will be across different countries. So I just wanted to understand, do we have to file taxes for each country in that way, or will that be taken care of in the US itself?
Usually you will need to consult with the same country's tax professional in order to figure that out. That's the truth.
All right. Yeah, thank you so much.
Thank you.
Okay. Hello, Tal. Thank you so much for walking us through this. I just have one question, and it has to do with you mentioned something about filing something with the IRS after you establish your corporation or establish your business. I wanted to know if it's for every type of business or if it's for a particular, like C corps, or does it also apply to LLCs and other types of corporation?
Generally speaking, when you start a register a company in the US, you're obligated to report taxes on that company. How you report and what form you need to file, depending on the type of company and your operation. There are certain exceptions. If you absolutely have zero activity, zero income, zero expenses for a partnership, for example, you might not be eligible. You might not be forced to file taxes on that, but in vast majority of cases, you do need to file taxes the moment that you establish the company and there is some operation in it.
So I think this one, you mentioned something about equity, and it's like filing it within 30 days of opening the company. Does that also apply for those, the ones where you are filing for, I think, the shares or for the equity that is associated with the corporate with the company?
Depending how you, if I understand correctly, depending how you issued the equity, you might need to report also the equity that you issued. For example, if you have an ISO, an employee in the US eligible for certain options, and they exercised their equity, you might need to file different filing for that. But generally speaking, you will that's something what exactly will be your tax obligations in matter of compliance, and I'll define compliance. Compliance is what you need to file in order, what I call, to stay out of jail, to be in compliance with the tax authorities. We all want to follow the law. We want just to build a business and make money. Compliance is what are the minimum that you need to file and report to the authorities in order to make sure that you're in good standing with them. And what exactly you need to file, depending on your specific situation, where you're registered, type of entities, your operation, etc. So that's something to work with your tax professional to understand what needs to be filed and when.
Okay, thank you.
Isaac.
Hi, Tal. Thank you so much for putting this together, even though you're sick. That's even more impressive.
We still relate to that.
Yeah. My question was around 83B election, and I was trying to figure out specifically. Can you still hear me? Okay. I was trying to figure out if it was too late for me to do that. I think I answered the question. I was kind of poking around. What would be where would you point us to? Because I started my Delaware C Corp back in February. But to my understanding, I haven't issued the stock yet. So I think that I'm still eligible for the 83B, but is there anything that you would kind of point me towards to figure out whether I'm still eligible or not? I don't know if you have enough details, but
so generally speaking, you need to file an 83B election on granted restricted stocks. So if you have options, those are not granted or restricted stocks. If you have options and you have vesting schedule and you do early exercise, Usually you convert the options into restricted stocks, and then from the point of conversion, you can file the 83B election. If you already issued the equity and the equity is restricted stocks, it's probably too late. If you issued the equity and there is no restriction, you just get a lot of the time when you issue the stocks or the shares in your company, you pay like, $1 or $2 to do it. If you already did that and you have no restrictions, you might not even need to file 83B election. It's a question that depends on how you kind of like register the company, how you issue the stocks, and the person who can answer that for you is either the lawyers of the company, the people who established the company, or the CPA that is filing the tax report of the company.
Okay. Okay, thank you so much.
Oh, thank you.
Hey, yeah, thanks actually, let's say, for walking us through. So I'm a solo founder, and I'm actually, let's say, I'm working on one of the company here, but it's still, like, say, I'm also working on as a regular time, full time, and something else too. So would I actually, let's say, qualify to do these deductions for the company that I'm actually, let's say, doing a solo one, or would I not be?
If you are profitable, if you have profits in the company, if you do not have profits, some of the deductions, like for example, the home office deduction, probably not eligible for you. Home office deduction is for profitable businesses. Other deductions might be relevant as well, and those other deductions and the losses that you generate from the company, theoretically you can take it against your W-2 or your full-time job income. Only if you report that on your taxes. But if it's like $200, probably will not worth to deal with it. But if you have like, $10,000 of losses and money that you put in, actually money that was at risk, you will be able to take $10,000 from your W-2.
Okay, nice. All right, thanks.
Sarah.
Hi, thank you for putting this together for us. I incorporated as
Thank you, Julia.
Delaware C Corp, and my question is, we generate income from the US and the UK market. So how do I go about filing taxes where we have different currencies that are bringing in revenue?
Gotcha. So it's actually the question, how do you manage your bookkeeping and finances? Are you based in the US, by the way?
I am.
Okay. So, well, I would assume from the accent, honestly. That's not a British accent. But generally speaking, number one, in your accounting, your bookkeeper, when you receive the income, they should kind of like record how much was received in the original currency, and then the IRS is publishing every year the conversion rate for tax purposes, and you're making the conversion based on IRS rates that they publish, and that's how you can figure out how to look at the numbers. But of course, you don't want to wait until the end of the year to know your final numbers. In that situation, you ask the bookkeeper to make their best kind of like effort and to use the current month or the current or some fixed price for that and make adjustments at the end of the year based on the IRS guidelines. That's the way to go. You want, as part of bookkeeping, to do that. Keep it simple.
And that applies to generating income from any other country as well, like just the conversion into
any currency.
Yeah, I understand. Thank you so much.
Any currency, of course. I think that's it. Thank you, everybody. Thank you, Darren. Thank you, Julia, for making this happen. And good to see you, everybody. And I hope that it was valuable to you. Of course, if you need any help or you want to talk to somebody from the team, feel free to book a call with us. But it was really a pleasure to speak with you guys.
Thank you all. And we'll be following up with some materials, or if anybody wants to talk about it specifically, please let us know. Thank you. Bye-bye.
Thank you. Have a great day.
Thank you.
Thanks, everybody.